Hello, everyone, and welcome to the Main Street Finance YouTube channel. I am, of course, Alex, your host, and today we're going to talk about 401k's. More specifically, we're going to cover how to analyze the options in your 401k plan. Now, what I have on the screen in front of you is what's known as a one-pager. Now, what a one-pager is something prepared by Morningstar and is typically given to just about every 401k provider. As the name would imply, it's a one-page summary of a specific holding in your 401k program. So if you're looking at buying Fund A, Fund B, or Fund C, each of those funds is going to have a one-pager so that you have something that's uniform that you can compare the three to decide which one you want to put your money in. Now, the one we have here is the Fidelity S&P 500 Index Fund, and the ticker for that is FXIAX. Now, usually there are two different kinds of holdings that you can invest in a 401k plan or a similar plan, and those are going to be the specific mutual funds like this is, and the other is going to be target date funds. Now, target date funds, instead of making this video way too long, I decided to make a second video that's specifically for target date funds. So you'll find that on the channel, but a lot of the base information is going to be here. So let's go ahead and start through it. Now, something to keep in mind as we go through this is that I had planned to do this video a lot earlier. So you'll notice that the date on here is for March 31st. And for those of you that are familiar with March 31st, we were in the middle of the coronavirus pandemic. Stock market was down 20 or 30%. Well, I would assume, did not want to do that. I would assume we were down 20% at the time this came out. So keep in mind that negative 20% carries over each year. So all three of these numbers are lower than they actually should be because at the time of recording, I think we're maybe 5% down from our all-time high. So all of these numbers going back are going to be wrong. They're going to be way too low because now this is no longer a negative 20%. So the first thing you have up here is the investment objective/strategy. This is just a paragraph of what they do. Fund normally invests 80% of assets in the S&P 500. Okay. Next, you have fees and expenses. So this is what you pay to have your money in the fund. So here, this is your total line. They put the total at the top. So you only get charged a 0.02% fee. So what that is just for fun. So let's say you have your plan with $50,000. So that $50,000, let's say you put it all in this FXIAX. So you take that 50,000 times 0.00. So that first two zeros are the full percentage points. So then we want 0.2. So this is how small this number is. So what this means is for every $50,000 you have invested in this fund, you are only paying $10. So you are paying a $10 fee per year for these guys to invest in the entirety of the S&P 500 so that you don't have to go in and invest in all 500 companies at the same time, which to me is a very good deal. So you're paying ridiculously low fees here. So again, this top line is the total line. So this is just a total of all of these. See, there's no fee here, no fee here, no fee here. So the entirety of the fee is just the total annual operating expense. And so what that is trading fees. So when they buy and sell, there's usually a fee that's paying the manager who runs this fund, who's actually doing those trades. All of that charges you this 0.2%. Operations and management is the next thing here. This is who actually runs this fund. So it is, of course, a Fidelity fund, which you had noticed up here in the bold. It's a Fidelity fund. These two guys are the co-managers. They usually have teams that work with them, but primarily it's these two. When was the fund first created? It was first created in 2011. If you wanted to call their number, and I really doubt you'd be able to talk to these two guys, but if you wanted to call the phone number, I bet that's just the Fidelity phone number. And then the website. So this is just how you can see who runs this fund, who these people are, all that good stuff. Benchmark. So the benchmark description is what you get for what's known as an index fund. So the index funds typically are trying to match the performance of something else. Here, our benchmark is the Russell 1000. So what they're trying to match is the entirety of the Russell 1000, which is also listed up here when they list their benchmark. So non-index funds aren't typically going to have a benchmark, but sometimes they'll just say, oh, well, our benchmark is the S&P 500. So if you're looking at investing in Walmart, then Walmart might compare themselves to the S&P 500 and just say, oh, well, we beat the market. We beat the S&P. So the benchmark is just what you're comparing your performance to. Then a category description. I'm going to kind of skip over this for a little bit, but this category description is this 3x3 grid over here. Basically, it's a size and then what they're going for, whether it's growth, value, or some kind of mix. So let's go up here. This is one of my favorites up here. So if you haven't watched my most recent YouTube video where I talked about common stock metrics, you get here, you have a return versus risk. And this is done by Morningstar. Morningstar is one of the biggest investment analysis firms, so you can really trust these numbers. I've looked at a lot of their in-depth reviews, and those things can be like 20 pages long, and me reading through it, it's good stuff. They consider everything. So the star rating. The star rating isn't necessarily if it's a good investment or not. What the Morningstar rating is the balance of risk versus return. So if you have something that's potentially going to return 20% next year, but you're going to have a really rocky way to go through it, it might be a 2-star. Even though it's a great return, there's a lot of risk for that return. So that'll give it a lower star rating. So this rating isn't for return. It's the balance of risk to return. So how they do it is 1 star is way too much risk. 5 stars is a lot of risk for a smaller amount of return. 3 stars means that the risk perfectly matches with the return that you get. So if it's a super high return, super high risk, 3 stars. So what we have here is 4 stars. So the reason we have 4 stars is because we have a high return, but an average risk. So if this was high and they matched, this would be 3 stars. But since the return is higher than the risk, you get 4 stars. Now, if this was flipped, if there was an average return for high risk, then you get 2 stars. So the point I'm trying to make here is the star rating is not how good the fund is or how good the return is. It is the balance of return versus risk. So then we come down to the performance. Now the performance, you don't get tripped up. So the categories are over here. So this is the return. This is year to date, so all of 2020. Now keep in mind, this is dated 3/31. So for the first quarter, they lost about 20%. Then you have the last 12 months, the last 3 years, the last 5 years. And these are annualized returns. So what this is saying is if you would have invested in this fund 5 years ago, you would have had 6.72% return per year. So that compounds. Then you get a load adjusted return. Now here's what I don't like. They get a little confusing. So a load is a sales fee. Now typically there's a front end load or a back end load. It's a fee. So basically this is your return if you consider the load fees. Now, load fees are also known as a sales charge. So if you notice, there is no sales charge. So because there's no sales charge, there's nothing to adjust because you didn't pay any sales charges. So these two numbers are going to be the same. And then you have the benchmark return. So as we remarked earlier, our benchmark is the Russell 1000. So the Russell 1000 over a 5-year period returned 6.22%, but this fund returned 6.72%. So this fund actually beat its benchmark, which is what they're trying to do. They're trying to say, oh, we did better than the market. We did better than what we were trying to even match. Category average. So for this category of mutual funds, here's what the category as a whole did. So the category returned 4.46%, but they returned 6.72. So this is really a top performer because they did a lot better than the category average. And then if you look over here, you get since inception. So we saw earlier, right over here, that this fund was created. This fund was created in 2011. So since 2011, they've returned on average 9.86% per year. So 2011 to 2020. So for the last 9 years, they've returned almost 10% per year. So then if you look at these are quarter end returns. So these numbers up here are calculated based on annual numbers. These are calculated as of quarterly. So in general, the numbers are going to be similar, but since the quarter ends are more specific, you get a more accurate result. But if you notice, they're basically the same. So then you get the disclosure. The disclosure is basically the, hey, please don't sue us line. Because if you do anything in investments, you'll hear past performance is not indicative of future returns. Individual risks can still apply, yada, yada, yada. So what they're saying is, even though we're telling you that they return 9.86 per year, you should not expect 9.86% per year. So you could basically, this is just them trying to make sure you can't sue them. Last couple things here, portfolio analysis. So this is the composition of what all they hold. So 98% of all the money they have is invested in US stocks. They have a little bit that's in non-US stocks, and then a tad bit in cash, which is to be expected because they hold on to cash, and then once they have enough, they make a big purchase. Top 10 holdings. So this is as a percentage of dollars. So of all the money they have, 5% is invested in Microsoft, 4% is invested in Apple, so on and so forth. And then this is the total number of stocks they hold. So this isn't the share count. This is different companies. So 1, 2, 3, 4. So this is counting the specific entities in which they hold shares in. Number of bond holdings. They don't have any bonds. Annual turnover. So annual turnover is important for non-index funds. The turnover is what percentage of the total portfolio are they selling and then buying something new. So, for example, if they wanted to get rid of Visa, like, hey, we don't like Visa anymore, they'll sell all their Visa shares and put it into something else. So that would be a 1.43% turnover because that's the stuff they sold and replaced. Typically, you don't want to see that above 20% because that just means they're overly trading. And people that do a lot of trading like that incur a whole lot of trading fees. So then your expense ratio is going to end up going up because these people can't make up their mind and they're going to keep switching. And then total fund assets. So this is in millions of dollars. So if you want that quick math, that's 6 million, tens of millions, hundreds of millions, billion. So this is $187 billion. And of that $187 billion, 5% is in Microsoft. So you can do that math and see how much money they have in each one. Now the last thing we have here is the Morningstar equity box. So first, let's do the right side, large, mid, small. So this is by capitalization or market capitalization rate, all that good stuff. Basically, the total dollar amount it would take you to purchase all the shares in a single company. There are different ratios, so large might be $100 billion. So if your company is worth more than $100 billion, it is categorized as a large capitalization company. So this is just where it is. Do we have a lot of big companies? Do we have a lot of smaller companies? Or do we have a lot of really small companies? So if you look here, you've got giant, large, medium, small, and micro. Now, naturally, the giant and large categories are very much overrepresented, and that's done on purpose. This is an S&P 500 fund. The S&P 500 is generally the largest 500 U.S. companies. So it makes sense that, 89% of their total holdings is in giant and large companies. It makes sense because it's the largest companies in the U.S. And then you've got value, blend, and growth. Value means you're buying a stock because you think it's undervalued. Maybe something happened to it in the news, and because that a whole lot of people sold it, so it's really low cost. So value is you're buying something because it's cheap or it's on sale. Growth means you're buying it because you think it's going to grow hugely. So think Tesla. Their stock is doing amazing, but they're not selling as many cars as you'd think. Well, people are buying Tesla because they think 5 years from now, they're going to be selling 100 times as many cars as they are now. So growth is you're investing in a company because you think it's going to grow a lot. And then blend just means you're somewhere in the middle. Like some companies you buy because you think they're cheap, some you buy because it's going to grow a lot. So what this is telling you is that this is a blend fund, so they play both sides, and then they're primarily in large companies. So that's what this grid is. And then the last thing is the sector balance. So the fund has 30% of its money in cyclical funds, and that's made up in 2% basic materials, 9% consumer cyclicals, so on and so forth. Now, there are 3 general categories. You got cyclical, sensitive, and defensive. So I don't want to go too much into what those are just because this video is already turning out a little bit too long. But what you do is, this is the percentage of the fund. So this is FXIAX, and then here's the S&P 500. Now, they should be trying to match it, but sometimes, stuff happens. So they're good at matching here. They're a little bit overweight in consumer cyclicals because they have more than what the S&P has. So keep in mind, they're trying to match this. So what we have is trying to match the S&P 500. So this is about how well they're doing here. Now keep in mind, prices change all the time, so it's really hard to keep this in an exact balance. And I mean, overall, they're doing a really good job. I mean, they're only off by a 1.5% here, 1.5% here, or 2%. So they're doing a really good job of matching it. And then from what we saw up here, they're actually beating their benchmark. So whatever these small changes are, they're doing all right with it. So this is how you look at and how you read a one-page report that's given to you. And with the information you get here, you should be able to go through, log into your 401k or your 403b or your 457 plan, and go through and see what you're invested in, see where your money is currently sitting, and there should be this kind of research document where it's just a one page. It probably is going to be this exact form, but obviously with the different information for the funds that you are invested in. So be sure when you go into work on Monday, because I'm recording this over the weekend, be sure when you go into work, go and log into your program and see, grab this and see how is your fund performing? How good are the investments that you're in? How expensive are the funds that you're in? And then once you've done that, you're going to notice there's also those target date funds. Now I'm going to release another video that's going to have the target date funds. So if you're in those, be sure to check that out, and I'll see you guys next time.